What you're witnessing here is not just a random cluster of candles. This is the market screaming its intentions. This is the raw, unfiltered power of wick rejections. Right here, at this critical resistance zone, the battle between bulls and bulls reaches its fever pitch. Look closely. Each of those candles is like a soldier making a desperate charge higher, creating a long upper wick as price is aggressively pushed up. But notice the critical failure. Not a single one of these candles could close above the line. Every attempt was met with fierce selling pressure, slapping price back down and leaving nothing but the tall shadows of failure in its wake. This repeated rejection is the market's clearest possible signal of weakness, a collective no from the sellers. For the astute trader, this isn't a sign of hope. It's a flashing neon sign pointing to a prime sell opportunity. The resistance has spoken. The question is, will you listen? Now flip the script. While repeated failures at resistance signal a breakdown, what happens when the market starts to consolidate its strength? This chart reveals a critical breakout sign brewing in the silence. Notice here, the first test of resistance was followed by a pullback spanning 10 candles. But the next time, the market only needed 7 candles to retreat and recharge before attacking resistance again. This shrinking time between attacks is a telltale sign of building momentum. Even more importantly, look at the lows. Each sell-off is finding a weaker footing, failing to break below the previous low. This creates a classic compression, coiling the energy like a spring. The buyers are absorbing every sell order with increasing aggression, trapping price in a tightening range. This isn't indecision. It's preparation. It signals that selling pressure is exhausting itself and a powerful breakout is increasingly probable. The walls are closing in and a major move is imminent. So the breakout we anticipated has finally happened. But here's where most traders get it wrong. They chase the move and get caught in the inevitable shakeout. The professional move is to wait for the pullback after breakout entry. This chart illustrates the perfect high-probability setup. After a clean breakout, price often retraces back to the former resistance level, which now, critically, acts as a new support zone. This retest is your validation. This is where you plan your entry, with a tight stop-loss placed just below this newly established demand area, defining your risk with surgical precision. The logic is powerful. If the breakout is genuine, this old resistance-turned support should hold firm. Your initial target is then set for the next significant resistance level above. This isn't just a trade. It's a disciplined execution of a classic principle. You're not buying the hype. You're buying the proven pullback, entering with the trend and with a clear risk-to-reward framework already in place. This right here is the entire game. It's not about being right on every direction. It's about managing your risk and reward so that your wins significantly outweigh your losses. This chart breaks down the golden rule with crystal clarity. Let's say your analysis points to a potential profit of 80 pips. Before you even think about entering, you must define your potential loss, which in this case is a disciplined 20 pips. Now, run the math. This gives you a risk-to-reward ratio of 1.4. For every single pip you're risking, you're standing to gain 4. This means you can be wrong half the time and still be highly profitable. Your stop-loss level protects your capital, while your take-profit level captures the move. This disciplined framework is what separates the amateurs from the professionals. It's not a suggestion. It's the non-negotiable foundation of every single trade you place. Master your risk and the rewards will follow. And now, let's decode a masterclass in market momentum and trader psychology. This chart reveals a critical pattern known as a rising wedge, a classic compression pattern that often leads to a breakdown. But how can we be sure? The secret lies in comparing the energy of the moves. Look at the initial powerful drop. It fell a sharp 2.5% in just 7 candles. That's strong, decisive selling. Now observe the subsequent pullback. It's labored, struggling to reclaim the same 2.5% loss. And it also takes 7 candles. This is the tell. The buyers are using the same number of candles just to retrace what the sellers took down in one swift move. This is inherent weakness. The pullback is obviously weaker than the drop. That's your signal. So the strategy is clear. We sell into this supply zone at the top of the retracement, anticipating the resumption of the downtrend. The core trading tip is brilliant. You can find the strength of buyers and sellers by counting the candles of a move. The more the weaker. It's a simple yet profound way to gauge who is truly in control. After learning about momentum and breakouts, the final piece of the puzzle is confirmation. Entering on a hope is a gamble. Entering on a confirmed signal is a trade. This chart illustrates the power of double confirmation. First, we see a successful breakout above a key level. But the savvy trader doesn't chase it. They wait. The price then does exactly what we want. It pulls back and retests the support zone, which was the previous resistance. This is our first confirmation. The old resistance has now become new support. But we don't stop there. As price bounces from this support, we get our second confirmation, a bullish harami candlestick pattern. This two-candle reversal pattern, especially with a long upper wick showing buying pressure, is the final green light. This is your high-probability long entry. Notice the no entry signal without this double confirmation. That's the discipline that prevents false breakouts. By waiting for both the successful retest and the candlestick signal, you stack the odds dramatically in your favor, turning a good setup into a great one. Now let's apply that same disciplined logic of double confirmation to a downtrend. This is where you avoid catching a falling knife and instead sell into proven weakness. Here, price is in a clear downtrend, breaking below a key support level, which then flips into a new resistance zone. The first attempt to rally back to this new resistance shows some struggle. Notice the larger, lower wicks, indicating buyers are trying to push back, but it's not a clear signal yet. This is a no entry. It's just noise. But then, we get the critical second confirmation. An evening star candlestick pattern forms right at that key resistance zone. This three-candle reversal pattern is a powerful sign that the sellers have regained absolute control. That is your confirmed entry. You're not guessing the top. You're selling after the market has shown you two pieces of evidence, the resistance level holding firm, and a bearish reversal pattern confirming the rejection. This is how you trade with the trend, not against it, by waiting for the market to give you the green light. And there you have it. From spotting the initial wick rejections at resistance, to identifying the breakout sign with building momentum, to executing the high-probability pullback entry with a razor-sharp 1.4 risk to reward. This is the blueprint. Remember, trading isn't about being a hero on every single candle. It's about discipline. It's about waiting for that double confirmation, whether in an uptrend or a downtrend, to ensure the odds are stacked in your favor. It's about measuring the strength of the move and managing your risk so that your wins are monumental and your losses are minimal. This is how you transition from reacting to the market to strategically anticipating it. This is how you trade not just with hope, but with a plan. Now take these concepts, apply this discipline framework, and go command your trades. Smash that like button if this added value, subscribe for more alpha, and I'll see you in the next video. Trade smart and stay disciplined.